Hi there. This is a quick message from Munro Partners that this podcast is general financial advice only, meaning it is not specific to you, your needs, goals, or objectives. We suggest you don't act on this information until you've spoken to your professional financial advisor. You'll find our full disclaimer linked to our financial services guide and website in the show notes below.
Welcome back to Invest in the Journey. I'm Ben Chamberlain, one of the investment analysts on the team here at Munro, and today I'm joined by two of my colleagues, Dan Condon and Nicky Sun. Welcome to you both.
Hey Ben.
Hey Ben.
And today we're going to dissect the Q1 2026 earnings season. Now, our listeners have heard before, at Munro we view the investment universe through what we call areas of interest, which are essentially long structural growth cycles that we see as creating the greatest opportunities for global growth investors like ourselves. And so for these thematics to play out on a singular stock basis, we need an event or a catalyst. So earnings becomes a great opportunity for the team to test these views. And so today we'll work through a few of our areas of interest, namely high performance computing, travel and security. So with that, let's get into it. So Dan, starting with you, before we get into the specific areas of interest or AOIs, how would you characterise this earnings season overall? Did the results broadly validate how Munro has positioned behind these AOIs?
Yeah, Ben, it was a strong earnings season across the board for Munro. AI led the way again. In this market, we continue to underappreciate the earnings opportunity in front of a lot of these companies across our high-performance computing and our connectivity areas of interest. It was also really encouraging to see a lot of these earnings beats get rewarded on the whole. So when stocks were beating their consensus estimates, most of the time we were seeing follow through on the results. And that was a good tell that these company fundamentals continue to outpace expectations. So the results clearly validated a lot of the team's work, which was great. But what was also really notable was the strength wasn't just concentrated in AI stocks. We had some great results across some completely uncorrelated areas of interest. To point out a couple, it would be like areas like innovative health and travel.
So the infrastructure piece of the AOIs has now delivered strong results for several seasons in a row. I mean, do you think this has become a bit of a normality? And I guess how does that change how we think about the opportunity from here?
Us as analysts, we spend a lot of our time on this, and it can be really unnerving at times to see stocks moving around in such a way in such a short period of time. But we also have to remember that the fundamentals are changing quite quickly too. And so how to sort of find our way through this noise is we rely very heavily on our packs or our earnings models in order to determine whether the price and the fundamentals are in check. So for every stock in the fund, we have a 5-year earnings forecast, and that's what we really rely on. And what we're trying to do is we're trying to mathematically prove valuation and earnings upside. And so the message and the answer to your question would be yes, there's expectations that are rising across the market and what is becoming the new norm, but across the board, earnings are actually rising faster as these fundamentals continue to strengthen. I'll sort of hit on it with two sort of high-level points. The first one being that hyperscaler CapEx, which is the big sort of profit pool for these companies, continues to grow and be revised higher every quarter. Our expectation is that it's almost approaching $800 billion worth of CapEx this year. I think just to sort of set the stage, like the irony was in 2024, everyone was calling 2025 the year of CapEx deceleration. In 2025, 2026 was going to be the year it decelerated. And now 2026 is going to look like, well, it's looking like 26 is going to actually accelerate year on year versus 2025. So by no means is this slowing down. The second point, and probably the biggest change since we last spoke, was that it's becoming clearer that the return on AI spend is improving dramatically. This is actually kind of hard to pinpoint down, especially as a lot of these companies are private who are sort of reaping the rewards of this spend. But if we just take an example that happened really recently, Google chose to rent some compute capacity from SpaceX at a price we can sort of determine is about $50 billion per year per gigawatt. So this was a decision to rent the capacity rather than wait for their own build. Now, let's assume that Google are a rational capital allocator, which I think we all sort of agree with, and they expect to generate a return well in excess of those rental payments, so that $50 billion per year per gigawatt. And so given that it costs $50 billion to build a 1 gigawatt data center and the economic returns to Google are greater than $50 billion, that implies that the payback on one of these 1 gigawatt data centers is less than a year. And so really fundamentally, as the return on investment gets better, we expect the hyperscalers just to continue to spend more for the foreseeable future. And what that means is for the picks and shovels of their AI build out at the bottom layer of the AI stack, so the semiconductor companies, the networking companies, power, equipment names, they're all seeing outsized positive earnings revisions across the board.
Okay, that set the scene really well. So I guess from that, let's dive into our first AOI, which is high performance computing. So I guess zooming out a little bit from this earnings season, I mean, what has it sort of told us about the build out of AI infrastructure? Do you still sort of see us being in the early innings, or do you think this story is starting to mature?
Okay, so let's take the ChatGPT moment as a starting point. So we are 3.5 years into what we think could be a 5 to 10 year infrastructure build out. So the $1 million question is it 5 or is it 10? So I recently traveled to San Francisco just a couple of weeks ago in June, and I was also there in December. And the biggest change in tone for me that I picked up was that demand actually isn't a massive point of contention anymore. It's actually all about supply and who has supply. And so what is the world short of at the moment? We're short leading edge wafers from companies like TSMC, and we're short memory. And the difficult thing for the industry is this is not something you can fix quickly. So it takes about 2.5 years from breaking ground on a new fab or a new manufacturing facility for these products until you reach volume production. Now, what all of these fabs begin with is you have to build a clean room. A clean room is a room that, I'm not joking, is 10 million times cleaner than outside air. And so what we can do is we can track these clean room companies, and what we're seeing is their order books are hitting record highs. So if we sort of just do a little timeline here and say, all right, well, you place an order with the clean room company, you wait X number of months, and then it takes 2.5 years from when they start executing the project to volume production. So basically what we're saying is there's effective visibility through to 2029. So to answer your question, it's probably most likely that we're early. We could be in the middle, but it definitely doesn't feel late. The other thing just to note as an aside is these supply constraints are actually really healthy. The fact that the AI infrastructure sort of ecosystem is so bottlenecked that it actually makes it kind of hard to overbuild in the near term because of just all the physical world constraints that we face. And so hopefully this should elongate the cycle for us.
Okay, great. You've sort of answered part of my next question, but I want to ask it anyway. I mean, internally, Munro sort of tracks the composition, I guess, of the demand of this build out and the hyperscaler capex, but that's only part of it. We're seeing sovereigns, enterprises get involved too. So I guess the question is, how do you see that mix evolving, and what does it mean for the broader durability of this opportunity?
Okay, so when we think about the evolution of demand, it obviously all began with the hyperscalers. We spoke about that before. But their capex is continuing to rise every quarter. In terms of the durability, well, this spending was funded and still is funded by some of the most free cash flow generative businesses in the world. So Google Search, Meta's ads, Microsoft Office, etc. But the kicker is that these core businesses are now getting enhanced by AI, which we sort of talked about. We think the return is getting better. And so for us, this bucket of revenue or spending on AI infrastructure is actually very durable. The other thing, what was most obvious when NVIDIA decided to resegment their revenue into hyperscaler revenue and non-hyperscaler revenue. And so non-hyperscaler revenue includes like AI clouds, enterprises, industrial companies, sovereigns, etc. And what really surprised us was that about 50% of NVIDIA's revenue is actually not from the hyperscalers. And the thing that surprised us even more was that NVIDIA expect that their growth will be driven by this non-hyperscaler bucket. So the non-hyperscalers are growing faster than the hyperscalers. So yeah, as I said, this was really surprising. And so in terms of how durable is this growth, well, a more diversified customer base, not just dependent on the hyperscalers, but broader industrial companies, enterprises, etc. More diversified customer base, probably more durable spending. And so I'll just caveat that with, we expect both of these buckets to continue to grow for the medium term.
That's great. Very, very comprehensive. So I guess like broadly thinking about the AI conversation and how it's sort of changed over the last few quarters, I mean, we've gone from talking about models and leapfrogging one another to more about agents and agentic inferencing. And what I mean by that is, these aren't just, questions that get answered, but, agents will actually go and do things autonomously at scale. So I guess thinking through that, what does that actually mean for the landscape across high performance computing? And, does it actually change the demand picture?
It does. It really does. So Anthropic released a product called Claude Code towards the end of last year, and that was really a watershed moment for the industry. AI really evolved from just answering questions to completing tasks, and again, further evidence of the improving return on investment on AI. So what happened as a result of the release of this product? Well, as a result, Anthropic's ARR, or annualized recurring revenue, it basically accelerated from $9 billion to $45 billion in about 4 months. Just to put it in perspective, that is the entire Salesforce revenue base. This is like never seen before sort of growth. And I bet you today that the number's a lot higher than 45 billion. And so what it does is this meaningfully changes the demand picture. I mean, it's probably the biggest reason why you've seen such outperformance across our high-performance computing areas of interest over the last few months. So if you go back to the 5-layer cake, just to sort of set the scene, like to support this parabolic growth, because AI has an input cost, right? You need compute. Anthropic are going to need to spend an awful lot of money on infrastructure to support this new sort of run rate of revenue. And so that's why these semiconductor companies and networking companies are ultimately benefiting now. If we sort of dig deeper and look inside our high performance computing area of interest, what's happening under the surface here, just to be clear, like we think all these companies are going to benefit on the whole, but within high performance computing, there's some big changes going on, and actually it changed or challenged a lot of our conventional wisdom. Those sort of long listeners, for years, we've been talking about the diminishing role of CPUs relative to GPUs in an AI era, and agentic AI actually flips that on its head. So if you think about a GPU, which is sort of like a brain, and a CPU as hands, like they're basically doing things. A chatbot just answers questions, so you can think of that as like a brain-heavy activity. But with agentic AI, if you're completing a multi-step task, which is orchestrated by a CPU, so the CPU will sequence the work, use the tools, execute the action, actually do things. What that means is that the ratio of CPUs to GPUs likely increases pretty dramatically, in fact. And so while you'll absolutely need both CPUs and GPUs, the relevance of CPUs has increased quite substantially over the last few months. And we expect that to continue with agentic AI proliferating across the masses. The second change is in memory. So an agent without context is like handing a complex job to an intern on their first day. You could have the smartest intern alive, but it's almost impossible to complete the task without knowing how the business actually works and having the right context or business context. And so that context only grows over time. And what it does is it pulls in every demand for every type of memory.
Great. Yeah, that's super comprehensive. And I think that's really important in terms of the ongoing debate that we're always facing in terms of return on invested capital for not only the hyperscalers, but I guess the rest of the supply chain as well. So Nicky, you've been spending time at the equipment layer of the semiconductor supply chain, speaking directly with management teams. What did those conversations reveal about how the industry is positioning for the demand ahead?
Yeah, so the equipment layer is a leading indicator for the AI infrastructure build out, we think, and chip makers essentially only spend CapEx when they believe the demand is durable. And right now they're committing. And the best way that we can see that is through wafer fabrication equipment, or WFE spend, which tells us how quickly customers are investing in the tools that they need to manufacture these advanced chips. So in terms of WFE spend, it's grown materially from around $100 billion in 2023 and expected to grow to $200 billion next year, which is above where the market thought this number could be even a year ago. And for us, the opportunity is to own the companies that are making the mission-critical machines that enable this capacity expansion. And so from our conversations with management this reporting season, what stood out is that demand is no longer narrow. It isn't just one customer or one cycle or one part of the market that's driving the growth. We're actually seeing breadth across leading edge logic as well as all throughout memory. And breadth is important because it means that this demand is more durable, so that these companies would basically feel more comfortable in increasing their own capacity to capture the demand ahead. It's also a similar theme amongst all aspects of semiconductor equipment. So when you think about lithography to deposition and edge and advanced packaging, it's all the same theme throughout.
Okay, so great. So let's pull on that a little bit more. And something that came up in one of those conversations was that customers are now doing something with their own supply chains that is seen as a bit unprecedented. Something that the people that you initially spoke with said they've never seen before. So can you maybe unpack that a little bit and explain what it is and why it matters for the broader AOI?
For sure. So what's generally unprecedented and linked to my commentary above is the fact that the customers are now providing much better visibility into the capacity. So historically, visibility was only a couple of quarters, but now we're hearing about visibility that extends much longer. So as an example, this earnings season, Applied Materials mentioned that they now have 8 quarters of visibility, and that's a direct result of conversations that they're having with their own customers. One example of what's driving this is the strong demand that we're seeing in memory that's been a step change. So with a strong demand in memory, supply hasn't been able to keep up, and this has resulted in the introduction of long-term agreements for memory supply. And when we think about memory historically, it's typically very cyclical spot price commodities, and buyers don't commit to pricing or volumes beyond a quarter or two. But right now, they're committing to these long-term contracts, and ultimately high visibility is positive for the supply chain as a whole so that these equipment vendors can better match their supply to their demand.
I guess China remains a bit of a complicated piece in all of this puzzle, both as a market itself and a source of supply chain risk. So how are you sort of thinking about that dimension at play right now?
Yeah, China remains important, but the way that we think about the risk has become a bit more balanced. So historically, China was one of the biggest swing factors for semiconductor equipment stocks. But more recently, China exposure has generally been trending down as a percentage of revenue for many of these equipment companies. And that's not because China demand has disappeared, but rather the demand from the US, Europe, Taiwan, Korea, and the rest of the world has grown very strongly. And so the portfolio view is that whilst China remains a risk that we monitor closely, it's no longer just the only driver of earnings, given this AI-related capacity expansion is becoming increasingly global, which helps reduce reliance on any single region.
Okay, great. Let's shift gears a little bit. And Nicky, I know you love planes, so let's move to the travel AOI, which is essentially built around the structural recovery and long-term growth of global aviation. Within this, I guess the aviation aftermarket or services arguably doesn't get as much attention as it probably deserves. So can you maybe explain to the listeners why Munro finds this piece so structurally compelling?
I do love planes, Ben, as I'm sure you do and the rest of the team at Munro. But within travel, we think about both sides of the equation in terms of demand and supply. So the demand is quite straightforward. Over the long term, air travel has typically grown faster than GDP, and people continue to prioritise travel like most of us here. But the more interesting and often misunderstood part is the supply side. So the global aircraft fleet is older than it's historically been, with the average fleet now over 13 years. And when you think about Boeing productions issues, as well as previous groundings, as well as the disruption from COVID, all this has meant that the industry hasn't been able to catch up and deliver the planes to the extent of demand. And so as a result, a lot of these airlines are flying their existing fleet of aircraft for much longer and using them more intensively. And we think that creates a very attractive setup for the aerospace aftermarket. And it's not as simple as a simple replacement where a part wears out and it gets replaced. There's actually a long installed base of planes and engines that continue to grow every day. And every hour an aircraft flies creates future maintenance, repair, and overhaul work. This work is also typically the highest margin and most recurring part of the aerospace value chain. So there's also positive mix effects. So GE Aerospace is a great example. It's a company that produces these engines that these planes rely on. And whilst the initial engine sale it makes matters, a large amount of the long-term profit is actually generated from servicing that engine over the life. So I guess to sum that all up, the key structural point is that older aircraft, high utilization, and constrained parts supply are all increasing the demand for maintenance, spare parts, and shop visits.
And so Q1 earnings season obviously came at an interesting time geopolitically. So how did this earnings season reinforce or test our conviction?
Yeah, it definitely added to our conviction. So probably worth noting the backdrop heading into reporting season. When you think about the travel area of interest, there's not a lot that can go wrong outside of the obvious, but one thing that's very negative is the war. And that was the one thing that we had going for us heading into earnings season. So investor sentiment was quite negative as we headed into results. But surprisingly and positively, despite the lack of travel in the Middle East region, the companies that we follow closely actually didn't show any material impact to their revenues. In fact, most of them actually beat and raised, which demonstrated the resiliency of their earnings. And as a reminder, At Munro, we believe that stock prices follow earnings, so the fact that they continued to beat and raise was really positive in our view. And so ultimately, we think that the diversity of their business models in mission-critical areas where demand far outstrips supply continues to support this earnings momentum. And maybe just to reiterate, it wasn't just one company, it was across the whole space where we saw much more resilient earnings.
Great, that's fantastic. So I guess staying on a bit of a sort of broader view, I mean, how are the companies within this space thinking about the best opportunities, in front of them, not only in the near term, but also in the long term?
Yeah, the interesting thing about aerospace and travel area of interest right now is that almost every company is telling the same story from a different point in the value chain. So the structural driver is simple, and it's the same that we touched on earlier, which is there's not enough new aircraft being delivered, which means that these airlines are flying their older aircraft for longer, creating demands across a few different areas. The biggest opportunity continues to be capitalising on that recurring revenue and spare parts needed for flying the older aircraft for longer. As I mentioned earlier, that's where all the margin is and where they should see much stronger earnings momentum. That's an area that we think will continue to be sustained and durable over the medium term. But another area that's not as much talked about, and one of the cooler parts of being able to cover this space, is that often when you're looking at these companies, you stumble across adjacent opportunities that are actually present in some of our other areas of interest, like defence and power generation. So we know that defence spending is increasing across Europe and the US. And when we think about some of the companies in this area of interest, the parts that they're making for the commercial aerospace sector is actually interchangeable across industrial gas turbines and power generation, and becoming an increasingly important part for their story as well. So when we think about the culmination of multiple end markets coming together, driving demand for the parts or the services that these companies offer, we just think that they're all very well positioned to benefit from all of these opportunities that are coming for them.
So Dan, coming back to you to close out with our security AOI, which encompasses defence, nuclear and critical infrastructure. How did this earnings season speak to the structural case?
So I'd say the structural case still persists today. So the biggest thing for the security area of interest is the current threat environment that remains high. We obviously still have active conflicts around the world, one in Russia and Ukraine and one in Iran. A global threat environment will tend to higher defence spending and obviously larger profit pools for companies in this area of interest. The other trends that have sort of been there have been like the US detaching itself from NATO, which has forced the Europeans to begin to spend more and have committed to raise the committed percentage of GDP going towards defence from 2% to 3.5% and sometimes higher in certain cases. And so what that's meaning is a lot of these European defence companies are the beneficiaries of this spending. The other trend that's popped up towards the beginning of this year has been the US budget itself. So last year we had a record budget, which was just over $1 trillion. That was sort of like an unforeseen and a very large number that people didn't expect. And this year it was initially floated that, or initially requested that the president was requesting a $1.5 trillion budget. So a 50% step up for a lot of these companies that typically grow sort of mid to high single digits year on year is a massive expansion of their total addressable market. Now, what we have to be mindful of and probably heard a little bit of caution over the recent earnings set period was whether this $1.5 trillion can actually get passed. It seems unlikely, but even if it's 1.2, that's still a 20% uplift to the spending pool, and we think it bodes well for companies in the security area of interest. The other thing I'll just point to is there's obviously a lot changing with respect to how conflicts are fought. We're seeing like the use of things like drones and air defense in Ukraine, and we think that's a good leading indicator for where spending is being directed. So things like the Golden Dome in the US, where the US are basically using air defenses and radars and satellites, etc., to defend the homeland, is something that's attracting incremental dollars and where we're sort of trying to find these key beneficiaries.
Okay, so there's a lot of structural growth here, but as we know, stocks don't go up in straight lines and things can pull back quite meaningfully. And I guess this is one of those areas of interest that we've seen that more recently. So I guess internally, if a stock falls, 20%, we at Munro refer to that as a trigger. Can you maybe walk us through our approach to risk management?
Well, look, it's different for every company. I mean, we have, on every pack, we have an investment thesis tab. So that's a good place to start. We have, let's say, 5 dot points of our bull case. If any of those are violated in a meaningful way, that can be a real cause for reconsideration. When we have a stock that triggers, is the whole investment team get into a room and we put the earnings model up on the screen, and we will talk through the pack, and the stock champion and the backup will either choose to observe the trigger, i.e. sell the position, or they'll ask us to defend the trigger, and we'll set a point in time, so let's call it 2 weeks from today, to review the trigger if it's still 20% from the peak. Now, this isn't meant to be a catalyst for us to just fire sale the company. It's also not meant to be some sort of ongoing thing that we review every 2 weeks. What we're trying to do is we're trying to figure out, have the fundamentals actually changed? That might be something we don't know straight away. It might take us those 2 weeks to figure out, but what we're trying to do is force the conversations internally to get to the best possible outcome. So by having the model on the screen, you open up scrutiny from everyone, whether your numbers are too high, whether there is a new emerging bear case we need to be mindful of. And so this is a really good way for us to find out whether we haven't sort of found the best company within the theme. This process really helps us do that. The other thing also is just like earnings revisions, right? So fundamental view, earnings drive stock prices. If earnings are going down or about to be cut further, that's probably not a good sign. And we might need to rethink, are they taking share of this addressable market? Is this addressable market growing in the way that we initially expected? So they're probably 2 quick examples, but it could be anything. It can be like something like a management change. It can be a strange M&A deal. It can be whatever. There's so many different ways that a stock can trigger, and ultimately we're just trying to figure out whether our earnings forecasts are correct and whether our view on the structural area of change is correct as well.
Fantastic. Well, that's probably a good place to wrap up this earnings season podcast. So a big thank you to both you, Dan, and Nicky, for going deeper into these areas of interest today.
Thank you.
The AOIs we've covered, high performance computing, travel and security, represent just a part of how Munro thinks about structural change and where the world's most compelling growth opportunities sit. If you want to learn more about how we invest, head to munropartners.com. And if you haven't already, subscribe to Invest in the Journey wherever you get your podcasts.